In the third part of my presentation, I want to look at the differences between RDR and MiFID II, and perhaps give you some tips on how to approach it based on our experiences in the UK. RDR affected all types of advisors in the UK, whether they were tied, restricted or independent, whether they worked for banks, insurers or advice firms. All advisors in the UK must charge fees for advice regardless of the type of advisor they are. However, MiFID II imposes fees for independent fund managers and portfolio advisors, but not for non-independents such as bank advisors. This has the potential to be dangerous for the European financial advice industry, since it creates an unlevel playing field that makes it harder for independent, fee-charging managers to compete effectively, but not impossible though. It is the proverbial elephant that is dominating the room, but nobody openly discusses it or questions it. The European regulators have essentially focused on the smaller, less well-developed segments of the market, but have left the universal, vertically integrated bank channel alone. It goes without saying that it pays to have competitive forces operating in a market, because they will strive to win customers, and they will ensure that they provide the very best possible service, the very best possible investments, and will ensure that customers get the very best possible outcomes. Those competitive forces will not be at work in the non-independent sector. The banking lobby is powerful, and French, German, Italian and Spanish banks have succeeded in keeping themselves out of scope for MiFID II. In the UK, banks played a minority role in fund distribution, but I have no doubt that banks would have lobbied in the same way for the same concessions in MiFID II if their presence in the market was larger. But having said all of that, there are plenty of reasons to be optimistic and plenty of ways in which you can battle the banks. I would recommend that you focus on what you can do and what you are good at, rather than what you can't do, and communicate that message well. Their universalism and blunt one-size-fits-all approach can be used against them, particularly when you can show how commissions can drag on investment returns and consumer outcomes over the long term. Of course, you must pick your battles wisely, but as wealth managers and high-end advisors, there are many important messages that you can use to emphasize why people should use your services and not the banks. The important thing to remember is that MiFID II is coming, so protesting is pointless. You are better off working with your regulator and shaping his thinking rather than being uncooperative. You can work together with your trade associations to ensure that you improve consumer understanding and educate them about the changes that are coming. Do not wait for the press or the regulator to do it. Controlling the message to consumers is the most important thing you can do. Many small voices are not as powerful as one big one, so work together. Advertise together, educate together, and make sure that this legislation works in your favour, and promote your differentiations. So let's come back to some practicalities. The most successful advisors and wealth managers in the UK are those that embraced the work they had to do and started the process as early as possible. So first of all, what is your business model? Will you continue to do the same, or will you focus on one type of service after MiFID II? Understand your game plan now, learn it and stick to it. I have a few lessons for the regulator while we're here. It is always important to avoid uncertainty. The introduction of MiFID II has had to be delayed because there were still too many loose ends, and loose ends cause a problem. In the UK, there were grey areas between what was simplified advice and regulated advice, and so many organisations decided to stay away from simplified advice. The FCA was forced to issue a paper clarifying its stance, and it was against this backdrop that robo-advice solutions began to be talked about. Regulators need to be clear about purpose, cost, time frame and the downstream effects. One such downstream effect that European regulators have ignored is the unlevel playing field and the advantage that MiFID II gives to bancassurers. So my greatest wish is that all investment advisors be treated the same and that we bring on MiFID III. So I want to end with some messages for you all. Message 1 is that regulation can create opportunities and not just threats. Message 2 is that RDR and MiFID II are supply-side reforms, and by that I mean that demand for advice, the need for investment product is still there. It's not going to disappear just because we've reformed how it's provided. All that is changing is how advice is given and how that advice is accessed. Message 3 is to collaborate with the regulator and not to be combative. In the UK, experience has shown that working with the regulator was much more effective than fighting the regulator, and things started to improve when people started to collaborate. Message 4, last but not least, define your proposition and business model. And that's it. Thank you.